Good morning, guys, and welcome to the podcast. I have a returning guest for us today, Steve Selengut. He's author of Retirement Money Secrets, and he was actually a guest on the show a year ago and is actually one of the top, most popular performing videos on YouTube, as well as the audio podcast on Spotify and Apple. Well, those links will be in the show, and I'm really happy to have him on. And he's here to talk about he's got produced a community, and we're going to talk about retirement secrets. Steve, welcome.
Thank you. Thank you. Good to be with you again.
Yeah. For those that are meeting you for the first time, introduce yourself.
Sure, I'll be happy to. Up until 2023, I was a private portfolio manager. I managed about $110 million for 150 or so families throughout the country. My approach was a little different than most money managers or investment advisors. I was focused on income generation. It was always my objective to make more spending money for my clients than they actually needed to spend so that we can continue to reinvest portions of it and grow the income while they're enjoying their lives. So it's quite a different approach. I actually created two different streams of income, one from the distributions from the securities I bought. They're similar. I guess most people think of dividend stocks as high income generators. I used a thing called closed end funds, which actually contain a lot of dividend stocks in them, but their payout rate is much higher. The second stream of income I produced was really from profit taking. I'm not one, and I think we all can relate very well with the problem with focusing on market value instead of income. Today, with the market down 10% from its high, it's almost down where it was a year ago, and most people's portfolios are still just paying 2 or 3%. So if they're retired, they have to take that their monthly expenses by selling securities, mostly at a loss. Whereas if you're in an income focused portfolio, a down market becomes an opportunity because the income doesn't change. You're not going to find any stocks that have yet lowered their dividends just because of the mess that's going on right now and the prospects for the economy. They just don't want to do that. Closed end funds pay the same amount of money and have not really changed in months and months, despite of what's been going on. And that historically, that's been the case through previous corrections. So you guys, a lot of people are looking at it. Oh, it's a terrible time. We're pulling our hair out because all our assets are going south. And we're looking at it, income investors like me are looking at it as an opportunity. Closed end funds, the select group that I use, are paying almost 11%. They mostly pay on a monthly basis, not 11% a month, but annualized 11%. They mostly pay monthly, and we're able to take advantage of the situation. So my background is in income investing. Since I sold my business 2 years ago, I've become an income coach. And more recently, I've taken that coaching and tried to spread it out in a community of people who are interested in income investing. The community itself is designed to give people half price coaching. It gives them selection universes for all the different types: taxable income, tax free income, stock market investing, and even a small number of ETFs that are particularly high yielding and reasonably safe, if you can say that. So they get that, and they get, right now we've had already 14 educational Q&As within the group, covering everything from profit taking to determine quality of investments to how to deal with the market cycle and how to deal with news. What should you expect when things? So it's an it's like you guys are all getting your PhDs and MDs and things like that. You weren't studying a whole lot of business. You weren't studying the stock market. You weren't studying things like that. This is the education that you didn't get there within this community. So that's what I'm about right now.
Yeah, interesting. Yeah, and you mentioned a lot of terms, key terms that we'll highlight. And a follow-up question I have for you is what is your process? How are you selecting for these investments for your own personal as well as your clients' portfolios?
Okay. For what I do is I select things for my own portfolio first, and I have a list of quality requirements. The fund has to be in operation for at least 5 years. There's got to be at least 50 different securities inside. The average age is probably about 25 years of what I do own, and the average number of securities inside is over 250 between all the different types of securities. So they've got here's an interesting one that you might raise your eyebrows about. They have to have significant volatility. I want to see this. I don't want to see upward, or I don't care which direction necessarily. I just want it to be fluctuating up and down because I'm taking profits to augment my income. So if the thing is just seems to be doing nothing, just straight in the same, sure, I'm going to get the 10% or so distribution income, but I'm not going to get any additional income. In last year, in 2024, which was not a particularly great year for the stock market. I mean, it did achieve all-time highs, but by the end of the year, it was on its way down. I generated the equivalent of 7 months income. So if you figure I was making so much a month, I got the equivalent of 7 more months of income from the profit taking I was doing during that period. I've already got 1 month's profits in the bag for this year so far, even in a down market. So that second stream of income is very important.
Interesting. Another question I have for you, because you mentioned income, and when I was listening to you, because you mentioned dividends, and then you're also mentioning profit taking. So your income generating strategies sounds like you have two already. What are other income generating strategies for your personal portfolio?
For my personal portfolio, I have a second type of profit taking, and I encourage my community members to do the same thing. But you know how when you have a portfolio and things go up and down, for us anyway, when things go down, we add to our positions. So we have what are called tax lots, the ones we bought in December, the ones we bought last November, October, and so on. But we always buy second lots when they're down, not when they're up, which is counter to Wall Street mentality. But we buy them when they go down. So when the market turns around and goes back up, we can start trimming those lots. The ones we bought most recently are going to become profitable while the entire position is still a little bit in the red. But we can take that money, usually it's short-term gains, like we take even 1 or 2% in the space of a month or two. Even if it's paying 10%, that's 2 or 3 months in advance. And then we add to other ones that are still down, or we buy new positions. So that's the third stream of income, is the streaming. Now, of course, my community, we all, when you get to be my age, you've got Social Security, you got pieces of pensions, you've got your RMDs coming from your IRAs. So there's a lot of different streams of income. But the community I've developed is a new business, basically income for me. But the interesting thing about it is that members who learn about what we're doing and encourage family members or friends or business associates to join the community, they can get 30% of the fees as long as they're in the community. So they can have, and I can have a fourth thing, like they can have another source of income from their membership of the community. It's a win-win type thing for
Yeah.
everybody who goes in it.
Interesting. What are your views on, because I know there's a lot of investors that use covered call options. It's almost like renting out your stock. What are your views on using covered call options for income generation?
I've never done it individually. I know a lot of people do, but it's got to be pretty time consuming, and you got to be on top of things all the time because
Mm.
stuff happens. So within the closed end fund arena, there have to be a dozen or more that specialize and do closed covered calls, buy right, type things, that buy and write, WRITE options trading. So we can do them, get the income from them, which is usually pretty high,
Mm.
and not take the individual risk ourselves and not have to watch over it all the time to see what's expiring and what's not and so on. And I also think that by having a professional manager do it, he's not going to be doing covered calls that aren't in the money. If they're not in the money, you lose more when you sell them than you got in premiums for selling the option. So you got to make sure they're in the money. So these guys are professionals and have been doing it for years, so I trust them. So yes, you do have the capability to do them. I have I own I when I used to manage money for people, I used to tell them that I would never put them in a security that I didn't own myself. So every one of the closed-end funds and ETFs that I use in my portfolios, I own personally, except for about half the tax-frees. Even though, and would you believe that tax-free closed-end funds are yielding 6.7% on average right now? Tax-free, federal tax-free, and state tax-free. If you get in your case, the California ones, 7% tax-free. Or should I repeat that? You've never in your life been able to get 7% tax-free, not since the 80s when we had the double-digit inflation. So I own all these things and I keep track of them.
Mhm. Another question I have for you is for the investors out there, because you mentioned closed-end funds, why some investors, if they're a little bit more sophisticated, they'll just buy individual stocks, a basket of stocks that they like. What is the difference between a closed-end fund and just buying individual stocks in your
The
experience?
closed-end funds, they own every stock you could imagine. So let's say, how much has Tesla gone down so far in the
Mm.
past couple months? 50%, 40%?
I
Is
mean,
it that
it's
much?
if I think it's trading around 250 last I checked. Yeah.
So I don't know how much. I never owned it individually, but I know it's gone down. If that stock is owned in some, I'm sure it's owned in some of the closed-end funds. It's just one of 150 or 250 companies. If there have been several, did I read one today? I know I read one I'm looking at my screen for Yahoo, and it tells you when something's declared bankruptcy. But I know there's been several bankruptcies the last couple of days. When you own individual stocks and they declare bankruptcy, you're done. The bondholders might get something back, but the shareholders never get a penny. When Merrill Lynch went under, the shareholders didn't get anything. The bondholders got about 50% on dollar, I think. But and same with Lehman Brothers. You didn't get anything if you owned it. But if you owned closed-end funds and even if you had both Lehman Brothers and Merrill Lynch in that same financial-based closed-end fund, you still didn't go under. You still didn't go under. Your net asset value may have gone down considerably. You might have had a problem, but they probably sold it long before the manager probably sold it as soon as the danger became. He didn't wait till the end. You know what I mean? So that's the difference. The closed-end funds are they have all the benefits of the mutual fund. And that's why mutual funds are so popular because they quote, it allowed the ordinary investor to participate in the growth of the economy without taking the risk of owning individual stocks, without trying to guess which one's going to be the next Amazon, which one's going to be the next Microsoft. They didn't have to guess anymore. They had a manager guessing for them with lots of different securities. And that's why mutual funds have become the staple in all 401ks and things like that because they're managed. Interestingly, in the 90s, ETFs became popular. They're also like closed end funds, but they became popular because they weren't managed. They were indices or they were just collections. So they were cheaper. And people say they're not paying as much money, they're better off. But closed end funds are managed, they're managed regularly. And then when the market panics, unlike a mutual fund, the manager doesn't have to sell his securities. In a mutual fund, the guy's got to sell the securities to give you your money back. With ETFs, you're trading one-on-one with another person, and I'm not selling mine at a loss, so the price is not gonna go down like a stock would, you know what I mean? So, that's the big difference. The final difference, and a really significant difference between them and stocks, these are trust vehicles. They have to pay 95% of their earnings to the shareholders. Most of the most popular stocks you find out there don't pay anything to their shareholders. Zero. The CEOs get very wealthy and the high-level executives, but shareholders usually get diddly. Even a quote dividend stock, 3 to 4% is what they usually pay. With closed-end funds, you get 95% of the earnings, and so you're making right now you're making in double digits on those. Big difference. Big difference indeed.
Yeah. The next question I have for you is how do you what is your criterion for fees? Because a lot of, you know, that's why a lot of the fees are very expensive.
Yeah, closed-end funds are actively managed, and a lot of them contain income securities like bonds and mortgages and so forth, and there is some detailed work going into the trading, buying, and selling them. And they pay interest on monies they borrow to buy more securities. So their cost can be as high as 3%. But you never see a bill. You don't pay a penny. The only time you pay money when you own a closed-end fund is when you sell it. There's a little fee charged in the selling transaction, and that's called when I was managing money, we weren't allowed to tell clients that was called an SEC fee, because theoretically that was a fee established by the SEC to fund the SEC. So every trade on the New York Stock Exchange, et cetera, there's a little fee. It's less than a buck. I think it's less than a buck. On every sell transaction, there's a fee that supposedly goes to the SEC. I don't know if it still operates that way. I don't know if it ever did, but that's what they used to call it. But that's the only fee you're going to see with closed-end funds.
Yeah.
With some mutual funds, you actually do get charged a fee. There's A, B, and C classes of mutual funds. You could pay a fee. On the ETFs I've owned, I've never seen a fee charged to me. They charge a minimal fee in the first place, but it's not paid directly by the customer.
The yes. So the other question we have from the audience is how do you view your investing process and strategy different from that of Charlie Munger and Warren Buffett?
Munger and Buffett are well respected by myself as well. They're From what I've known, what I've read over the years, is that they're really value investors. They're value investors. They're looking for quality. They're very well diversified. They literally own companies. I just own CEFs that own companies. So they're very diversified. They make plenty of money. They're getting income somehow from all this stuff, and they do trade. They do take profits. They're exactly like me, just a whole lot wealthier. So I think I'm in their, let's say, I would be in their fan club. I would be in their I would do similar type transactions as they do, quality-based, income producing, diversified, profit taking. They take profits occasionally, but probably not as often as I do. The only difference is I'm not nearly as wealthy.
Interesting. Another follow-up question I have for you is given this day and age of inflation, high taxes, high tariffs, the fiscal debt of the US government, is 6 a good return? Because a lot of people are like 6%, you're actually falling behind given cost of living, etc.
For a lot of people, if they can get 6%, they're lucky because they're not going to get it in any of the bonds they buy or individual securities they buy. They're not going to get 6%. In closed-end funds, you can get a lot more than 6%. But we're in a pretty unique. It's unique in recent years, put it that way. We've had double-digit inflation and double-digit interest rates in the past. I remember years ago buying a New York Port Authority municipal bond, tax-free municipal bond, yielding 12%. Now, as soon as interest rates went back down, it was called, but still, I got a year or two's worth at 12%. But it's different than what we experienced recently. Interest rates before the financial crisis,
Mm.
5% was considered low interest rates. It didn't get any lower than that. What was your first mortgage? My first mortgage was, I think, 7 or 8%. No,
My first mortgage was 5.8%. So
5.8. You're younger. Uh,
but my brother, his mortgage was 1.75%. So
yeah, he's really young. Mine
yeah,
right now is 2.7
yeah.
because of refinancing. But so here we had literally decades, maybe 40 or 50 years where interest rates were never anywhere near as low as 5%. Then we have the Great Recession and we use lowered interest rates to pull everybody up from it. And for 12 years, the stock market went up and interest rates went down. So we had zero interest rates. Now, and then we have 18 months where the Fed takes interest rates from 0 to 5%. So it was a crushing blow. It went so fast. Never had it ever gone up that fast. And that's where we are right now, 5%. And you've got probably 17 years of people who have never experienced 5% interest rates. They think it's high. They're scared of these 5% interest rates. And I'm saying, wow, interest rates are still low.
Yeah.
So it's a different mindset or a different mentality between the old guys like me and the younger people of where we really are in the interest rate cycle. We're higher than we were for the last 12 years, but we're not
Mhm.
high historically. What's going to happen with interest rates, with inflation? There's almost as good a chance that we'll have a couple upticks. Let's
Mhm.
say we were in a normal inflationary period where it was just demand pull or something like that. The Fed would lower interest rates to control it. But we're in an environment now where we have a couple people who seem to be testing all of the economic theory there possibly is, who thinks we can scare the world into somehow making the United States a better environment than it is today. We've never experienced that before. We're going to have 4 years of it. I don't know what's going to happen with interest rates during that period of time, but the problem the Fed is going to have in controlling it is they may not be allowed to raise interest rates. That could
Yeah.
make things a little scary. With closed end funds, if they're forced to lower interest rates, income focused securities are going to go up in price and we're going to make money on it. We're going to
Mm.
make profits because the prices are going to go up. If interest rates go up further, if if not enough loud voices protest and they do go up higher, we're going to have lower prices. But for the most part, there's not going to be deterioration in the incomes that are being paid on existing fixed income securities because we're not going to have a lot of defaults, or at least we shouldn't. People are going to still buy stuff even if the prices are higher. We might have problems with debt. It's really an unknown. Nobody knows what's going to happen tomorrow, but you never know what's going to happen tomorrow. So it's just a little scarier now than normal.
Yeah.
Yeah. I have no prediction capabilities. I don't have any crystal balls. I just know that over the years, I've always been one to try to take advantage of corrections in the market and to similarly take advantage of upturns in the market. I never buy and hold. Everything's for sale. I'm running a business here. It's my portfolio that's my business. And I've got securities in there that are for sale, every one of them. And you give me a price that's a profit right now, I'm taking a profit right now. I don't care what the amount of the profit is. I'm going to take that profit. And I got so many things to choose from that are paying me over 10% that I can almost buy anything in my list.
Hmm.
So that's the environment I'm in. I'm not in a scary environment. I'm in an unknown environment that I've experienced many times. And the approach of buying when things are lower to improve your yield has always worked in that type of an environment.
Hmm. Interesting. Yeah. Yeah. A lot of interesting points. And how can people find you and check out your book and check out your community, connect with you, etc.?
Okay, the book Retirement Money Secrets, in case somebody wants to see it,
Mhm.
don't want to walk by it in the store. It's available at Amazon and all the brick and mortar and other online areas that you go to. And there's an Audible book as well. There wasn't an Audible book the last time we spoke,
Wow.
but now
Excellent.
there is. And it's the Audible book is over 800 copies already.
Mm.
And the paperback and ebook and stuff like that have about 5,700. That total around 6,500 have been sold so far, which is pretty
Excellent.
good. So that's it. The book will lead you to me. My website is theincomecoach.net, and the community is the RMS for Retirement Money Secrets, Income Investing Community, and it's on the school platform, SKOOL. So if you just go to school and look for communities, you'll find it. You'll find it. It's also there's a link to it in the book too, the community. But the community is a growing entity, and we've got a full-blown educational program in there for investors. And most of the concepts apply to all kinds of investing. Quality is quality. It can be stocks, it can be bonds, it can be anything. Diversification, income, profit taking, dealing with market cycles. It applies, and stuff that I applied to my business managing money before I even started using closed-end funds.
Excellent. Well, thanks so much for coming on and sharing your wisdom and expertise. And the for the audience, the links will be in the show notes. And we really enjoyed having you on again.
Thank you. It's been a pleasure to be back.